Welcome back to Financial Clarity for Doctors, everyone. This is Rachelle Vanderzanden here with Corey Janoff.
Hello.
Hello. Thanks for joining us today. Today, we wanted to talk a little bit about some basics of inheritance. And we've talked about this a little bit in terms of what it means to leave behind a legacy for other people. But I think with a lot of our clients and a lot of Gen X and millennial folks, many people stand to inherit money from their elders, from their family members. So that we wanted to talk about the other end of that a little bit today and what it means to inherit money, what that looks like, what some tax consequences are, how you should plan for that. It may vary quite a bit from person to person how much they inherit. It could be a tiny bit, it could be a good chunk of money. It really just depends. And it can come in lots of different forms. It could be real estate, it could be investment accounts or IRAs, it can be business interests, lots of different things. So, we're just going to talk about some of the implications about that and encourage you to talk to your family, which is hard because no one wants to talk about their death and their wealth or their parents' death and their parents' wealth, but definitely worth having some open conversations about if your family is willing to do that.
Yes, communication is key with anything in
Mm-hmm.
life. Business partners, colleagues, patients, clients, spouses, kids, parents. Um, the the more open that line of communication is, the less confusion there will likely be. But yeah, you've probably read or seen headlines of articles here and there over recent years about the impending great wealth transfer, where to put it not so lightly, boomers are eventually going to die off, and they are currently the wealthiest generation. And odds are they're going to leave some of that money behind, most of it to their children or grandkids, maybe a little bit to charity. But some estimates say that baby boomers own about 50% of the country's wealth, and that Gen X and millennials are set to inherit approximately $72 trillion over the coming decades. Another study estimates 90 trillion over the next 20 years will transfer mostly to millennials. Um, and it's largely concentrated in the wealthiest 10% of the country. We have a little bit of wealth inequality here, but most people aren't going to be leaving an inheritance behind, but the top 10%, top 5%, top 1% will likely have a decent amount of money to leave behind, most likely to their children and maybe some other relatives. But even if you inherit just a little bit from your family, it's a great planning opportunity to really sit down and see how you can potentially shore up your own finances, further your financial goals and your path towards financial independence. And, as with everything, it kind of depends on individual circumstances, what the right way to do it is, what's the most appropriate course of action. Should we spend it? Should we invest it? Do we pay down debt? Do we donate it? It really all depends. But a lot of things to consider here if you are set to receive an inheritance from someone in the future, or near future even.
Absolutely. So today we'll spend a little bit of time going through different kinds of assets that you can inherit, what the tax implications are, how you can potentially use them. But I think before we do that, it's important to talk a little bit about how money and assets pass from one person to another. And that's just talking about some estate planning basics. We've talked about this a little bit before too, but this transfer of wealth and assets can be smooth or complicated depending on how much planning ahead has been done. If there's a large transfer of wealth, it's always going to be somewhat complicated. Like there's not a way to make that incredibly smooth if there's just a lot going on. But there is a process called probate, where when someone passes away, the state is somewhat involved in how that money goes from one person to the next. And if you have a will, that probate process can be very simple because then it's like we follow the instructions on the will, we follow whatever the accounts say the beneficiaries are and things like that. If there is no will, then the state kind of has to determine based on how closely people are related and things like that. And in every state, it's a little bit different. So that process can be more complicated and more expensive when there is no will in place. So doing that estate planning ahead of time, leaving clear instructions can be really important to avoid like excessive time going through that process and also, excessive costs with that as well. With some accounts like IRAs and 401ks and things like that, you can have a beneficiary listed on them. And that actually is more important probably than the will. Maybe not more important, but it's very clear. And then that's what happens. Like whether or not that's what matches up in the will, if that's how it's listed on the account, that becomes the most important thing. So
There
that's
was a great
yeah, go ahead.
article in, I think, Wall Street Journal this week. So this is early June when we're recording this, about a guy who passed away, I guess, a few years ago. And um, he had his ex-girlfriend from the 1980s listed as his beneficiary on his workplace retirement plan. And they broke up in the 1980s.
Oh my
And
goodness.
his brothers, I guess he never married, or maybe he married briefly and then divorced, but whatever. His brothers like are inheriting all of his other stuff, but there's like this $1 million retirement account that's going to his ex-girlfriend that he hasn't seen or talked to in 40 years. And of course, lawsuits. So yes, check your beneficiaries on your accounts, because that will most likely supersede anything else. If a person is listed as the one to receive the money, the company is going to send a check to that person.
It's so important. And that's something to talk about with your parents too. It's so awkward to have these conversations. And we have created this expectation that we don't talk about money. And I think that those barriers are starting to come down very slowly, but it's important. It's so important. And obviously money is not everything, but your parents, your grandparents, whoever they are, they want to make sure that money goes to who they want it to go to. They don't want those mistakes to happen. So I think that's just a really good open conversation to have about, oh, hey, is this something that everyone has done recently, whether you have siblings or not? Maybe it's just a conversation you have about, hey, I read this weird article in the Wall Street Journal where this guy left all of his 401k money to his girlfriend from 20 years ago on accident. That's silly. Like, let's make sure that doesn't happen to us. So you can use some anecdotal evidence and stories to bring up those topics if it's challenging. Um, yeah, I think it's hard. No one wants to talk about death again, but it is important.
Yeah, encourage your parents. I mean, most likely this is, a conversation with your parents, because,
Yes.
parents usually give the money to their kids, but it's not always directly distributed that way. But for most of our listeners, many of you still have living parents, hopefully, and hopefully they live a long, long time. But eventually your parents' financial situation is going to become your financial situation, for better or worse. So the more you can encourage your parents to have open discussions with you and make sure their stuff is buttoned and updated, their will, estate plan, etc., is the way they want it, updated, and it'll go a lot more smoothly that way. And yeah, like Rachelle said, it's having the conversations can sometimes be tough. A lot of people don't want to talk about it. Some people, especially the older generations, are still very guarded about their finances. Even with their adult children, they don't feel comfortable discussing their finances with their children. But, keep poking and prodding, and hopefully things will transition as smoothly as possible when that day inevitably comes. Because the downside, if it's not smooth, there's just a lot of confusion, a lot of frustration, and potentially excessive legal fees that you'll be spending trying to sort things out. So if there's conflicting information, if there's confusion, like maybe their will says one thing, but their beneficiary designation conflicts with that. They named their ex-girlfriend even though they were married, and they have, yeah, the will says give it to my spouse, but their IRA says give it to my ex-girlfriend from 20 years ago or 40 years ago, like that. That's going to create some issues. And laws and regulations and rules change over time. So yeah, the attorneys are the ones that are set to make a lot of this money if things aren't buttoned up and smooth.
Yeah, absolutely. So there are a lot of different kinds of assets that you can apparently inherit. And we're just going to walk through a few of those real quick. One kind of straightforward one is life insurance proceeds. If someone passes away and they have a life insurance policy that is paid directly as cash, no taxes taken out to the named beneficiary, unless that beneficiary is a minor, then that money might have to go into trust for them because the life insurance company can't, give $1 million to a 5-year-old. So that can be a little bit complicated, but most of the time it's pretty straightforward. Retirement accounts also go directly to the named beneficiary. So as long as you have a beneficiary listed on your account, that is who it goes to. So that again supersedes any instructions in a will. It has to be listed correctly on the account itself. There can be both pre-tax and Roth retirement accounts, which we've talked about lots of times before. For pre-tax accounts, especially, there's RMD implications, which are it stands for required minimum distributions. That just means that if you inherit a pre-tax retirement account, you most likely will have to take out all of the funds within 10 years of the date of death of the person that you inherited it from. I think the exception is a spouse, right, Corey?
Yeah, spouses can inherit it without having to take RMDs until they
Over 10
reach the
years. Yeah.
required age.
Yep.
Um, but yeah, so if your spouse dies, assuming it's like most people have set up, the surviving spouse would receive all the money. And although not always, if there's, second marriages, things like that, that's where the estate plan is super important. Maybe it is a second marriage and, they have kids from a first marriage that they want to receive some of their assets. You don't want to necessarily give it all to the new spouse. That's not the mother or father of your children. And then your children are kind of hung out to dry and your stepchildren are set to inherit all that money down the road. Maybe you want it that way, but yeah, super important, especially with blended families, to have that estate plan buttoned and beneficiaries the way you want them. But yeah, spouses would inherit retirement accounts, and it's basically treated like their own retirement account. And then you have to start taking required minimum distributions at a certain age. That age varies, but moving forward, it starts at age 73, and then I think in the 2030s
75 in a
goes to
couple of years. Yeah.
yeah, I think is it 2030 or 2033 that it goes to 75,
Yeah.
something
Something
like
like that.
that. If
For most
you
of our listeners, you'll be 75 probably
yes,
when you have to take required minimum distributions, unless it's an inherited account.
and who knows, the odds are it'll change again before, if you're
It
in your
could.
30s or 40s, they might update those RMD ages, but before you get to 75.
Yep.
Um, so yeah, RMDs deplete within 10 years for most inherited retirement accounts, unless the owner was already taking RMDs. So if your parents presumably are over the age where RMDs are required and they were taking RMDs from their accounts already, you're supposed to continue those RMDs annually while still depleting the account within 10 years. It's
Mhm.
complicated to know all
It
the
is
rules.
complicated. Yeah, so that's one of the more complicated accounts that you can inherit. And we'll talk a little bit about the tax implications of that in a bit too.
And the
That
penalties are pretty steep if you don't take the RMDs. They recently announced they're waiving the penalty again this year. I think they waived it during COVID, and then again for 2023 or four, it's been waived for inherited accounts. But yeah, if you don't take required distributions under normal circumstances, it's a pretty steep penalty. It used to be 50% of the required amount. Now I think it's 25%, only 25%, but still, that's a pretty hefty penalty tax that you're paying if you forget to take your, required amount out each year.
Absolutely. Yeah. One other kind, I mean, if you just inherit investment accounts that are not retirement accounts, you don't have to deal with like all of that kind of stuff. The cool thing about those accounts is that you also get what's called a step up in basis to fair market value as of the date of death of the person that passed away. That's like a lot of mumbo jumbo, but what it means is that normally when you have just a taxable brokerage account, you pay taxes on any gains in the account from the date that you purchased whatever it is that you're holding in the account. But for inherited accounts, the dollar amount that you don't pay taxes is actually the value at the date of death of the person that passed away. So whatever it's worth when they pass away, that chunk of money you don't pay taxes on, even if a lot of it was gains. You only pay taxes on the gains that happen after that person passed away. So between when that person passes away and when you sell it, if there are gains in that time frame, you pay taxes on those gains. So it's pretty cool.
So for a quick example, let's say I have a $1 million investment account, and over the years, I put a total of $400,000 into it, and the rest is just investment earnings. It grew by 600,000. If I were to sell that $1 million account in full, I just want to cash it out, go on a awesome vacation, whatever.
$1 million vacation.
Exactly. Yeah. Let's have a bender in Vegas one weekend. But yeah, I would normally have to pay taxes on that $600,000 gain, at capital gains tax rates. But if I die and leave that $1 million account to my kids inherit that account with a $1 million cost basis, meaning if they sold that account for $1 million, they would pay zero taxes. If they sold that account for $1,001 a day later, they pay a taxes on that $1 of gain. So you that $600,000 gain that I had obtained during my lifetime is wiped away. So pretty big. If you leave those types of accounts to your heirs, they avoid a lot of taxes potentially.
Yep. And property is the same. So if you have a property, like normally, if you sold your own property, you can exclude the gains on your primary residence. But if you have like real estate holdings that are outside of your personal property or your primary residence, you can't. But if you have, someone who inherits property from you, they don't have to pay taxes on anything, like whatever the value is at that date of death. If it's $1 million property, they don't have to pay taxes on any gains that may have happened between when you purchased it and when you passed away. It's just any additional gains above and beyond that $1 million of new property value, then you would have to pay taxes on those gains. So that's also very advantageous. It's a very, very similar tax treatment as with the non-retirement investment accounts.
Business interests. So some of you or your family members might own their business, a medical practice, a law firm, accounting business, own a bunch of, self-storage company, whatever. If someone passes away, they potentially are leaving the business to their heirs, or if you had partners, the share of the business to the heirs. So this is where it gets a lot more complicated because a lot of different things could potentially happen. And it's important to have the transition planned out ideally before you die rather than after the fact. So if you have partners, having a buy-sell agreement in place is important. What happens if one of us dies or is permanently disabled and can no longer work in this practice? How are we handling that? If the person who dies, are they required to sell the shares back to the surviving partners in exchange for money, most likely? Or does their spouse inherit their share in the business? And do we now have to bring on their spouse as a partner in this business? For some businesses, that may work. For others, it may not work at all. If you're a licensed physician and your partner dies and you're now partners with their non-licensed spouse, that's not going to add a whole lot of value to the business. And the spouse would probably rather have the money instead of the share of the practice. So, a lot of groups have buy-sell agreements where it's predetermined. All right, if one of us dies, then we give, their spouse or heirs money in exchange for their share in the practice, and everyone's happy. Now how do we come up with that money? We can't just pull it out of thin air. Maybe the practice is lucrative enough and has enough cash on hand that they can just cut a check, or maybe it's stated in the agreement that it's paid out over 5 years in installments. Maybe we all have life insurance on each other to where if one of us dies, the life insurance, spits out the necessary cash to buy the shares. So a lot of different things there. If you're a single owner and you're leaving the business to your heirs, or again, if you're the one on the receiving end of this, do you want to inherit that business and keep it running or hire someone to run it for you? Maybe not. Maybe you have zero interest in owning that business. You see sometimes this with professional sports teams. The owner dies, leaves the business to their children, and then it's a giant mess because some of the kids are involved, some aren't involved. They argue, they aren't as hardworking as the parents who grew the business, and it's a lot of drama that plays out somewhat in the public eye in that scenario. But it happens every day behind the public eye with smaller businesses where parents leave a business they built to their kids, and you have three kids, one of which has zero interest in the business, more of a free spirit. The other lives on the other side of the country. And then there's one responsible child that's there trying to run the business, but they've got a day job and kids, and it's just not feasible, or maybe they're involved in the bit. Who knows? So having that all planned out ahead of time is definitely important. Do you want the business, or do your parents want the business to survive and continue? Do they want it? Do they have a planned liquidation or sale at death? Um, who knows?
I feel
It's
like we could have a whole separate conversation about businesses and buy sell agreements and things like that. But yeah, it's really complicated when you're dealing with business assets a lot of the time. Yeah. Another one that is somewhat complicated, and we could probably have an entire episode about, is trust assets. So, if you have money inside a trust, or if you have your will set up so that money flows into a trust when you pass away, you can potentially avoid probate with all those trust assets, which means, the trust is dictating how that money is used. Like there can be very specific instructions about how that money is used and for who. And then usually there's a trustee that's assigned. There always is a trustee that's assigned to determine like how to facilitate that, how to make sure that what's happening is in accordance with the trust instructions and those assets are being used accordingly. So it can be really useful, especially with large estates, to have that trust in place to avoid a lot of costs with probate. But again, it can be complicated. Definitely something worth paying very careful attention to and working with an attorney closely to set that up and make sure it's set up according to what you're really trying to accomplish.
And probate is just a court process where a judge oversees the distribution of the asset. So anything that's not held in a trust or is not an asset with a named beneficiary, like life insurance or retirement accounts, just the money goes straight to the beneficiary. But anything else, like your house, investment accounts, etc., if it's not part of a trust, it goes through a court process in the state where the judge oversees it. And if there's a will that's clearly spelled out that says, all right, my kids get this money equally, okay, this money goes to the kids, stamp, done. But if there's any confusion, that's where the judge is involved and attorneys are involved. And ultimately, the judge is going to make a decision on how things are going to play out. And it can, again, if it's not clearly spelled out, it can be sometimes a bit costly with those legal fees trying to sort through it all.
Yep. And then one other one is annuities. So you can sometimes have that set up for retirees, especially where, you have a chunk of money that you put into an annuity that's now providing an income stream potentially, or maybe was designed to provide an income stream in the future. Usually there's a named beneficiary on an annuity, and there could be like a death benefit associated with that when someone passes away, like you get this chunk lump sum of money, or it could be that the income stream continues with the person that inherits it. So it all depends on how the annuity is set up. And that can be a lot of different ways. Like, and it could also be like retirement or not retirement. It could be like a qualified annuity or a non-qualified annuity. There's so many different kinds out there.
You have some clients where they've received an annuity that was already spitting out income and they just are continuing to receive that income stream. Other annuities, it's just a death benefit similar to life insurance. So, yeah, it really varies, but this is all where the communication is helpful and knowing what your parents have and how it's going to play out when you eventually receive it. So there's no surprises or confusion.
Yep. And I would
Taxes,
say,
or go ahead.
yeah, no. That's important too. But I was just going to say that I think it's most important to know about these things ahead of time, is because sometimes, like the advisor that your parent was working with is not super excited about trying to figure out the back end of it because they know you're probably just going to move your money anyway. So, and that happens most of the time when you inherit money from your parents. Most people, not all people, but a lot of people move away from that advisor to a new advisor that they're working with or more comfortable with. And so the person that's, your parents' advisor in this example is trying to work through all of this back end stuff that they feel like they're not getting paid for. I've literally had advisors tell my clients this, which is so ridiculous and like not acceptable. But if you can like understand it as much as possible ahead of time, it will get you over some of those hurdles when it happens.
And not to sound ageist, but odds are if your parents are old, if they're working with an advisor, that advisor is probably old too. And they've got one foot out the door. They're getting ready to retire. Maybe they're just still working with your parents and a handful of other clients because they like them and they're friends and they don't have any interest of bringing on someone new and sorting through this stuff. And like Rachelle said, odds are you don't have a relationship with that person. You're going to move the money elsewhere anyways, either to your own advisor or to, if you're a do-it-yourselfer. So it's like, it's just more effort on their end for no payout or benefit. And yeah, so
Other
there's
than
just,
it's part of their job. That's what I wanted to tell this guy. I was like, this is your job.
it is and isn't to some degree, depending on the circumstances. Like, is it the parents advisor's job to help the parents' kids sort through an estate? I mean, maybe. Is it? I don't know. It depends what the scope of their services are. So
Mhm.
they might be just, financial planners that focus on the planning and the investment management. But they may not be experts on estate planning. Maybe a separate
Mhm.
attorney did the estate planning. You can make an argument it's the attorney's job to figure it out. They're the ones who know this stuff. They set up the trust and everything. So I don't know.
Yeah, it
Um,
totally depends on what we're talking about,
yeah,
obviously. Yeah.
but yeah, like if it's an investment account that's managed by the advisor, yeah, they do have some responsibility to help with that transition and, make sure that the assets are dispersed to the appropriate account as per the instructions of the trust or the will.
Or the
Um,
beneficiary designations that are literally
exactly.
listed
Yeah.
exactly on the account. Yeah.
So, and that's not too much effort. It's like, all right, send this IRA to the new owner. Pretty simple and straightforward. But if beyond that, if it's getting more complicated and involves more advanced, planning, working with attorneys, etc., like I could see some 75-year-old advisor just, who's on the golf course 4 days a week because they only have a dozen clients. I mean, I wouldn't have the expectation. My expectations wouldn't be super high for their involvement in helping with that transition.
Yeah, absolutely. Okay, so the next thing we want to talk about is taxes, because that's important too when we're talking about inheritances. So, the big one that people often think about that is not that huge of a deal right now is actually estate taxes, which are based on the total value of the estate at the time that the person passes away. So, it's the net worth, including life insurance policies owned by the decedent. That's the person that passed away. At the federal level, there is an exemption right now of up to about $13.6 million per person. So if your estate is worth $13.6 million or less, we do not have to worry about estate planning taxes at this date, like right now. And that number is also indexed for inflation because it's a per person number. That also means, if we're talking about two parents, that's up to like $27 million per couple, basically, in 2024. Um, that number was doubled with the Tax Cuts and Jobs Act back in the day when President Trump was president. And it is set to expire at the end of 2025. So starting in 2026, presumably that number would be about half of what it is, unless they pass some additional legislation to extend that or to change it, update it, whatever it is. So in that part, we just don't know and we won't know. Most people don't have estates that are valued larger than that. Like it's not a huge concern for a lot of people. Could be for some of you. Another thing that's really helpful to talk to your parents about if you think that they have considerable assets. The one other thing is that with estate taxes, each state has its own laws about estate and inheritance taxes as well. Some of them don't have any, and other ones have like really low exemption levels. Corey and I live in Oregon, and at the state level, it's like a $1 million exemption. So your estate can be a lot smaller than that $13 million number, and you may have to pay some state taxes in Oregon. So lots of different things that you can look at there.
Yeah, and for a lot of people, it's not the money, the asset values add up quicker than you think. You look at your net worth and include the value of any life insurance owned by you, or if it's
And
your parents.
property.
Yeah, your
Mm-hmm.
house, your life insurance values, um, IRAs, retirement accounts, taxable accounts, etc. I mean, it's not hard to get to a seven-figure net worth.
Yeah.
Um, and when you add up all those things. So in certain states, yeah, there's going to be a six-figure, maybe even seven-figure tax bill due at death, even if you're below that federal exemption.
Yep. And that can be really challenging if you don't have a lot of liquid assets in the estate, especially, so if there's taxable brokerage accounts and things like that, okay, like we know where we're going to pull this money from to pay taxes. But yeah, it's definitely worth looking at and making sure that there's a plan in place if that's going to be an issue.
And those taxes, it's not like you inheriting the money has to then cut a check. The taxes are paid by the estate before the money is dispersed. It's kind of like your paycheck. The IRS withholds some taxes before they actually give you the money. They want to get their money before sending it to you.
Yep.
Other accounts, have tax implications like retirement accounts. If you're taking RMDs from a pre-tax account, you have to pay taxes on the amount withdrawn every year. Roth
And that's based
accounts.
on your income tax level, like
Hmm.
your income tax bracket.
Yeah. So, Roth accounts don't have taxes. They still have the RMD requirement for inherited Roth accounts. Brokerage accounts, we talked about that already. There's a step up in basis, so the tax implication should be pretty minimal if you're cashing those out shortly after death. But if you hold on to them for a while, you would pay taxes on any investment earnings from that fair market value at date of death. And similar with real estate property, if you inherit a house or rental property or something like that. But trusts, can be definitely helpful in facilitating the transition of things and helping follow the original owner's wishes, but it can also make things a little bit more complicated. And there are some tricks and tools that help mitigate taxes with trusts, but again, it can also potentially increase taxes depending on the type of trust and how it's used. So we won't get into that today. That's a better one for an estate planning attorney, but there's a type of trust for everything. Um, and if they're used correctly, they're great. If they're not used correctly, they're just expensive, complicated things.
Yeah.
So, what to do with the money you inherit? All right, we've got the money. What do we do with it?
Yep. Pause, take a breath, think about it a little bit. If you're getting like liquid cash, just park it in a high interest savings account for a little while until you have a game plan. And honestly, like the estate planning and probate process can take a little while. So between when someone passes away to when you actually get the assets, you may have plenty of time to think about it. But there's lots of access to high interest savings accounts out there. We have access, and lots of investment advisors have access to FDIC insured accounts with much higher limits, where they spread it out across lots of different banks to increase that FDIC insurance value. So that's definitely something to think about if you need to just park the money somewhere while you're making a game plan.
And you won't
But
have accounts at
yeah,
all those different banks. It's like you get one account, the bank itself behind the scenes spreads it out across a number of FDIC insured banks, and you can get in a lot of cases up to $25 million insured on one single checking account or savings account and still
yep.
get that, at least at the time of this recording, a 4 or 5% interest rate on that account. So a good option, if you're inheriting millions of dollars, trying to figure out what to do with it. All right, I can get a high interest rate and it's FDIC insured while I figure this stuff out.
Absolutely. Yep. I think if we're early on in our careers and we still have like short term, like consumer debt, credit cards, personal loans, anything like that, knock it out. Get rid of it. Like that high interest rate debt, if you have cash on hand to get rid of it, that's probably the best use of your money. As always, it depends, but probably the best use of your money. And then beyond that, make sure you have adequate cash savings. Just bolster your emergency fund if you need to. Lots of people already have that in place, but just in case, if you don't, look at that. Make sure you have an adequate fund in place. And then the next part, the thinking about it part, is just reviewing what your long term goals are. What do you want to achieve with your money and with your resources? What is important to you? What do you value? Is it early retirement? Is it college funding? Is it making sure that you just have extra money in the background? So if something happens to you, you're fine. Like, do we want to cancel our disability insurance? Are we officially like financially independent at this point? Like, there's so many different things that you can think about. You can also think about, what if it's above and beyond what you need personally, what do you think would line up with the person that left you the money most? Like, what did they value? Did they have any charitable goals that they didn't get to accomplish, or that they didn't provide for in the will, but they kind of hoped you would? Um, yeah, maybe you plan a yearly vacation at your favorite destination that your parents went to. Maybe we make it a tradition. But it could also make sense to do something big for your short term goals. If you really have above and beyond what you need, maybe this allowed you to buy that vacation home that you really wanted and that you hadn't been able to afford quite yet, or that you hadn't felt like you could do responsibly before. So it's okay to spend some of that money. I think it's just important to take a breath, think about it first, and make sure you're planning according to what your values are, which is something we talk about a lot too.
There we go. And then, yeah, consider some of the tax implications there. When and which accounts to draw from, what to potentially invest elsewhere, which accounts to just leave alone, or which assets to leave alone. Hold
Mm-hmm.
on to property, sell property. What's the market for those assets? If you inherit some real estate and it's a down market for real estate, maybe it's not the optimal time to sell. Maybe it's a great real estate market and now's a good time to cash in. How much of a headache is it to keep those properties or business interests and manage them? Is that of interest to you or not? Do you just want to rid yourself of it and move on? So
Yeah.
again, it depends. Everyone's circumstances is different.
And
Uh,
everyone's goals are different. Yeah. One other thing that I just want to mention real quick about the pre-tax accounts and those required minimum distributions is that just because you have to take the money out doesn't mean that you can't reinvest it somewhere else. And I think that's something that sometimes people just like, there's just a little gap in like what we're thinking about here. But if you take out that required minimum distribution, but really you want to leave that money invested for long-term growth, you just turn it around and you reinvest it in a taxable brokerage account or whatever it is that kind of lines up with your goals. So make sure you're using those resources in a way that makes sense for you.
yeah, definitely. Easy to reinvest money, endless places to invest. Um, let's see, review invested assets. If you inherit money, chances are the goals and objectives of the person you inherited it from are a little bit different than the goals that you have. And the objectives might not be the same. So you might need to make some changes to how things are invested or handled. Probably smart to meet with a financial advisor to sort through some of this stuff and make sure you're not missing anything. All the I's are dotted, T's are crossed. You've thought of all the possibilities, tax implications, options, strategies, etc. What are your goals? What's your time horizon? Yeah, the money does not need to stay with the group your parents were working with. If your parents were wealthy and had a lot of money, that group will probably want to retain you as a client. Um, but at the same time, and it might work out great for you to continue working with them. It might be a good relationship, a good fit, but you want to make sure you're working with the person or the group that's right for you and that you're comfortable with and that can help you achieve your objectives. Um, and yeah, period.
Period. I think the last thing that we wanted to just kind of end on is like, don't make your parents plan your plan or your retirement plan. Just don't be like, oh, parents have so much money. I don't need to save for retirement. I can just spend all my money. Like, do your own savings first. You never know what could happen. Like, we just don't want to count all the chickens before the eggs hatch. Like, we still just have little ideas of what this could look like. Even if you're talking about it regularly with your parents, like, still take a little bit of responsibility for your own financial plan because obviously things can change. If you're, and also like, life expectancy varies dramatically from person to person. If your parents die when they're in their 80s, you may inherit quite a bit. They may have a lot of leftover resources. But if they live until they're 102 and spend several years in long term care because they were older and needed some support, that may not be the case at all. You may end up having to support them in some way at some point. So it can vary so much just depending on what the situation is with those people that may leave money behind.
Yeah, hard to predict the future. Some people are healthy, you think they'll live forever, and then boop, they're gone. Had a heart attack or something happened and got them. Other people, you look at them, they're not in the best health or best shape, and they don't seem to take care of themselves very well, but they keep living. They just keep on going, and they make it into their 90s or beyond. And it's like, how did that happen? But so yeah, it's like Rachelle said, don't count your chickens before your eggs hatch. I wouldn't plan on receiving an inheritance because that's requiring a bit of luck. As we talked about in our last episode or the one before, a couple before, increasing your luck surface area. If you're planning on inheriting $5 million from your parents and that's your retirement plan, well, it might work, it might not, totally out of your control though. So if you can take on some responsibility and ownership and make sure your own objectives are accounted for with your own planning, then any inheritance you receive will be icing on top of the cake and only help you accelerate your objectives and goals and get to that financial independence point sooner and maybe be able to do some more fun stuff in addition.
Absolutely. I think it's hard to talk about this stuff and like separate the finances from all the emotional stuff too. We get it. It's your parents. You love them. You don't want them to die. But it still makes sense to be aware of like all the financial implications that go along with that inevitability, I guess. Ooh.
Yep. Well, thanks for listening. I'll see you
Yep. Have
next
a good
time.
one, everyone.